Welcome everybody then. Hopefully you are watching this on either the latest Internet Explorer or Safari or Chrome, because we'll have a lot of interactivity in this video, and I want you to also pause the video a lot as we go through it, okay? So here we go. Here's a question, a proper past exam question. We see it's an SFP, and so the first thing that we decide to do is S's equity table. So we start off here, S's equity table. We do it straight away in the exam. It will calm us down because we're so used to doing it. Okay, so having a look at S's equity then, and when I say S, I'm talking about Park in this part, right? I want you now to pause the video and then think about what goes in to share capital, retained earnings, and other components of equity then. Have a look. Pause the video now. Okay, welcome back then. So what you should have realised is that you have share capital, retained earnings and other. You put everything in from S's equity, and it's these three figures here then, the 230, the 170 and the 14. Now, what would at acquisition be then for S's equity? 230 as well. We always presume that's the same figure. Then we need to go find out what Park's retained earnings were and other reserves were at the date of acquisition. So pause the video now and have a look. So the retained earnings then, you needed to try and dig it out from somewhere, were 115. and other reserves were 10. So you just take one from the other, so retained earnings then is 55, and then other post-acquisition is 4. So far, so good then. What we do now is we add all these up, and that comes to 355. Is that the book value or the fair value of S's net assets? Okay, as that's the book value of S's net assets, then I want the fair value. So I need to go looking around for the fair value of S's net assets at the date of acquisition. And you'll see that they are 360 million due to land. So 360 means a 5 difference due to land. Does land have any depreciation? No, it doesn't, so that's good news. Go put that 5 somewhere. Let's have a look then to see where we would put that 5. Where would you put it? Hopefully you got it right. You add it on to Park's PPE when we come to add it all across. Perfect. Okay, so far so good. Let's have a look at this paragraph here though. Park still held a franchise right at the 1st of June 08, which is the date we acquired it. It had a fair value of 10. Well, I want that fair value. It's not been recognised in the financial statements of Park at the moment, so it's not in the books, but it has a fair value. So I need to bring it in. So I need to bring in an extra 10 here, this franchise. So far so good then, so that makes that 370. Then I need to carry on reading the paragraph, and it said the franchise agreement had a remaining term of 5 years. Why did it tell us that? Yeah, to depreciate it, so it would be 10 over 5 years times by however long we've had it. So we acquired it on the 1st of June 08 and our year end is November 09. So we've had it for 1.5 years. So we want 1.5 years worth of depreciation, or you could have done it in months. And if you did that then you would get 3. Total depreciation so far would be 3, so we put that there, we put that there, and then we say, right, we need to go put this to the franchise, to P's figure somewhere, and I don't really have any space for it. So what I would do in the exam, I would create a new line here called intangible assets, or call it franchise, and then just put there 7. Okay, so create a new line for it. So far so good then, that's that bit done. 55 plus 4 minus 3 is 56. So what would we do next? Goodwill. So let's have a look. Goodwill, as we all know, it's the fair value of consideration. It's the fair value of NCI. If we're doing the fair value model, we need to check that, but I think I remember we are. And the fair value of net assets acquired, which I already know what they are. They are the 370 there. Okay, so let's go back up to the question. Pause the video now and tell me what is the fair value of NCI at the date of acquisition. And the fair value of NCI is 150. So 150, and then how much did I pay for it? The purchase price was 250. So I can put in all that in. There's no mention of any impairment, so therefore goodwill is 30. So I could go put goodwill in then. Instead of investment in park, that now becomes goodwill of 30 for when I eventually do my proper answer. So far so good. What would we do next? NCI. So NCI is at acquisition plus post acquisition with no impairment to worry about. At acquisition is always the same as that, which is 150. And then post acquisition will come from the post acquisition. Let's have a look at what percentage. We own 60, so therefore they will get 40% of 56. And 40% of 56 is 22.4. So that comes to 172.4. Okay, now, before I move on, I want to have a look at this last bit here, the bit that we haven't looked at. It's a Grange acquired a further 20%, so a further addition from the NCI for a cash consideration of 90 million. So, let's see if we can remember how to do a further addition. Let's do it down here, a further addition. Step 1 is to calculate NCI at the date of the further addition. The date of the further addition is the year end, and that's what I've calculated there. So I know that that's 172.4. Step 2, I calculate the fall in the NCI. And the way I do that, so the fall in NCI, the way I do that is I take my original, I divide it by what that represents at the moment, which is 40, and I times it by how much I've how much the further addition is. And the further addition is 20%. So I times it by 20, and that gives me a figure of 86.2. Okay, 86.2. That's what I have made the addition of, and therefore, look, that's what NCI has fallen by. So if NCI has fallen by 86.2, I may as well put it in now. 86.2 fall, leaving me with 86.2 as well. And we call that minus the transfer on the further addition, because we acquired it from the NCI. Alright, so NCI is 86.2, everybody's happy. Now, step 3 is compare the amount I paid to this fall in NCI. So how much did I pay for this amount? I paid 90 million. If I paid 90 million, can you pause the video now and tell me then how much have I gained or lost if I paid 90 million for this 20% from the NCI? Okay, what you should realise is I compare 96 to 86.2, so I paid 90, but I only got 86.2, so I've made a 3.8 loss. Where does that 3.8 loss go? Yeah, to other reserves, and we've got an other reserves this time, so I can do it. So, let's deal with that then. Let's first of all, though, let's do retained earnings and other, okay, together. There's a reason why. So, H to begin with. So we go all the way back up. It's not H, is it? It's Grange, but H, you know what I mean. Their retained earnings were 410 and their other was 22. So I can put that in. 410, 22. Now I know in the other reserves I want to put this 3.8 loss. So let's put that in. So loss on further addition. forgotten already, 3.8. Then I want my share of S. Now this is where you have to be a little bit careful. What you want to do is you want to say, right, put a box on other. And I want my share of that 4 in my other reserves, okay? So that would be easy then. So for S, all I do is I say, right, I want my 60% then of the 4, which is 2.4. Okay, so I just put that 2.4 in, and I'm done. That's so far so good for other. What about S's retained earnings though? Well, if I've taken the 4 here, I don't want to give S's retained earnings 60% of 56. I want to give it 60% of 56 minus that 4, don't I? So I want to give it 60% of 52. You get used to doing that after a while. So 60% of 52 comes to 31.2. And that's all we can do for this question, because we've only done the first note up here. So as we've only done that, you wouldn't want to finish off the retainers or the other reserves, because there might be other things that affect it. But that is it. So far so good. If you got to this stage in the question, trust me, you are well on the way to passing it.